History tells us that the 21st century has been anything but ordinary. Profit margins, stock prices, and interest rates have all fluctuated wildly. Mortgage rates are higher than in years. Similar trends happened before major market downturns. Are we headed for another significant economic event? Could this be the scenario legendary investor Jeremy Grantham has warned us about? Need help keeping up with the ever-changing business landscape? Workerty is your solution. It's your free, one-stop shop for getting the word out, whether running a small shop, freelancing, or looking to fill a job opening. List your business, post those classified ads, or browse the marketplace. It's a hassle-free way to make connections. Now, let's unpack the intricate economic landscape we face. The economy lately has been more unpredictable. Profit margins swing wildly. Interest rates are soaring after chilling near zero for too long. Honestly, it's enough to make your head spin. And you know what's crazy? This scenario, the inflated stock prices, record-breaking profits, has happened before some seriously nasty market downturns. It makes you wonder, are we headed for another significant fall? Can this inflated market party keep going forever? Now, here's where things get even weirder. While the cost of practically everything seems to be skyrocketing, one thing is technically getting cheaper: your mortgage. Stay with me here. See, when inflation rears its ugly head, the value of money changes. That big, scary 30-year mortgage you signed a few years back? Well, the money you pay towards it in the future won't have the same buying power it does today. Inflation slowly erodes the actual value of your debt. Let's use an example. Imagine you borrowed $200,000 in 2021. With inflation hovering around 10% in 2022, the real value of that debt dropped by $20,000 in just 1 year. If inflation averages around 6% in 2023, that's another $12,000 off what you effectively owe. That's a substantial amount. Of course, this doesn't mean your monthly mortgage payments magically disappear. Rising interest rates are still a significant pain point, leading to that whole mortgage time bomb situation you might have heard about.
No young kids coming out can buy a house. This is not a stable equilibrium. Furthermore, the mortgages have gone from 3, which explains everything, to 7, which explains nothing. And eventually, the 7 will start to explain quite a bit.
The ideal would be a mortgage that adjusts with inflation. Your interest rate would reflect the actual cost of borrowing, and the amount you owe would change with those rising prices. Unfortunately, most mortgage contracts today don't work that way. So, what next? Lenders need to get creative with how they help borrowers facing these higher interest payments. Since inflation will chip away at the debt over time, offering flexibility could help people stay afloat. After all, navigating this economic roller coaster is tough enough as it is. And hey, speaking of economic predictions, did you know that legendary investor Jeremy Grantham has some strong opinions on where we might be headed? Jeremy Grantham's bubble theory. Alright, let's dig deeper into Jeremy Grantham's bubble-busting ways. This guy isn't your average market analyst. He's got a reputation for sniffing out bubbles before they pop, with some serious impressive calls under his belt. For instance, he saw the dot-com bubble of the late 1990s coming, and even predicted the 2008 housing market meltdown. So, what's his secret sauce? Grantham pays close attention to a few key indicators that often signal an overheated market. Abnormally high profit margins. When companies make record-breaking profits hand over fist, even during a less than stellar economy, something's fishy. Historically, these kinds of profit levels need to be more sustainable. Think of it like a balloon pumped too full. Eventually, it's gotta give. Inflation. This one's tricky. A little bit of inflation can be healthy, but when prices start spiraling upward, it creates a dangerous cocktail. Investors tend to get caught up in the hype, scrambling for anything that looks shiny, and valuations can become wildly disconnected from reality. Growth instability. A healthy economy grows steadily, but a bubble economy is a roller coaster. Rapid bursts of growth, followed by sudden slowdowns, show a lack of stability. This environment makes it too easy for a significant market correction to take hold. Grantham believes we're smack in the middle of a giant bubble. The stock market is hitting record highs, profits are through the roof, and it all feels too familiar. He even warned that 2022 could see a nasty downturn driven by inflated valuations. And you know what? He wasn't far off. The S&P 500 did take a 19% tumble that year.
A few months ago, smart people were saying there was a 20% chance of a recession in 3 years. I mean, it is quite amazing. And what happens after the bubbles break is there's always a recession pretty quickly. And people never get it. People never forecast it. And along with the recession comes a drop in profit margins.
But here's where things get interesting. The recent explosion of interest in artificial intelligence, AI, has thrown a wrench into the works. The market bounced back, fueled by investor excitement, and Grantham sees this whole AI situation as a temporary bubble within the giant bubble. It's a temporary distraction, and he expects that enthusiasm to fizzle out fast. His track record and focus on all those telltale bubble signs mean his warnings are always worth considering. Let's switch gears for a moment. Are you worried about the economy and what it means for your business? Don't just wait and see. Get proactive. Workity.com has your back. This completely free platform is your one-stop shop for reaching new customers, filling those open positions, or even offloading excess inventory. List your business, post those classified ads, browse the marketplace, or sell directly to buyers. It's the hassle-free way to boost your visibility and keep your business thriving, even if the economic waters get choppy. Workity.com, your free solution for navigating those potential economic headwinds. Comparing past bubbles to today's market. Now, back to those market comparisons. Remember those crazy days in 1929 and the dot-com boom of 2000? We might be seeing some unsettling echoes of those market eras in how things are shaping up today. Before you start panicking, it's important to note that history doesn't perfectly repeat itself, but boy, are there some interesting parallels. Picture this. Nvidia's stock skyrockets by a mind-blowing 1,000% in just 4 years. Now, flashbacks to Cisco's meteoric rise and devastating 80% crash in 1999 might have you sweating, and for good reason. Seeing that explosive growth pattern can set off alarm bells, making us wonder if we're headed for another tech bubble burst. But hold on a second. Before panic sets in, remember that numbers don't always tell the whole story. Price-to-earnings ratios, PE, reveal a massive difference between Nvidia and Cisco. Nvidia's PE ratio is currently around 26. Sure, not cheap, but a far cry from bubble territory. Cisco, during the dot-com mania, a whopping PE ratio of 472. That's the kind of insane valuation that signals unsustainable speculation. So, what's fueling Nvidia's growth? In large part, it's their rapidly expanding business and increased profitability. That's another significant distinction from the dot-com days, when many companies were more hype than substance. Tech stocks, on average, have doubled their profit margin since 2004, sitting comfortably at around 26% today. These profits provide a much more vigorous justification for our higher valuations. Speaking of valuations, the average PE ratio for tech stocks today is 28. While historically high, it's nowhere near the nosebleed territory of 1999 when it hit 50. See the difference? Those higher valuations make more sense, considering that tech companies have doubled their profitability. Here's where things get interesting. Smaller companies are currently trading at historically low valuations, reminiscent of 1999. This stark difference between small caps and large caps could present an opportunity. In the past, such a gap usually leads to small caps playing catch-up, like right before the 2001 recession. Another noteworthy signal is the gap between the Russell 2000, small cap index, and the S&P 500. While the S&P 500 surpasses its all-time highs, the Russell 2000 is still way below its record. This happened in 1999 as well, right before those small caps went on a tear. Could history repeat? In the short term, don't bet on another massive bull run. Let's not forget that an inverted yield curve is waving a giant red flag, just like in 1999.
We should be in a recession, mild or severe is the question, but we should be in some sort of recession fairly quickly, and profit margins from a real peak have a long way that they can decline.
Back then, the stock market ignored it and kept climbing. Despite those recession warnings, we're seeing a similar pattern right now, a resilient stock market. However, the S&P 500's 5-year return is currently around 79%. Good, but hardly the mind-boggling 200% returns we saw during major bubbles like 1929, 1987, and 1999. This tells us the market might not be quite as overheated as it was during those times. The dominance of a few mega-cap tech giants, the Magnificent Eight, is another echo of the dot-com era. But even here, there's less cause for alarm. Market concentration is a risk, but you won't find the same level of investor frenzy that fueled the insanity back then. So, what's the verdict? While some parallels to the dot-com days are unsettling, today's market sits on a firmer foundation thanks to increased profitability and less extreme valuations. Still, with recession signals flashing and investor excitement potentially rising as we move into the later stages of this market cycle, it's time for caution, not full-blown panic. Grantham's warning: is a crash coming in 2024? The legendary investor and market historian Jeremy Grantham believes we're skating on thin ice. He sees trouble brewing for 2024, forecasting a disappointing year for the U.S. stock market, a weakening economy, and the genuine possibility of a recession. So, what's got him so worried? Primarily, it's those sky-high valuations. The S&P 500 is trading at a price-to-earnings ratio of around 34, which puts it in the top 1% most expensive periods in history. Grantham also points to record high profit margins for companies, which he believes are unsustainable. In his view, investors are pricing in an overly optimistic future that might not come to pass. Some experts argue that today's valuations are justified, suggesting things are different now. They point out that the S&P 500 has been trading at an average PE ratio of around 27.5 for the past 30 years. While that's true, Grantham's argument still holds weight. Those record-breaking profit margins have a lot of room to fall, potentially taking stock prices down with them. Navigating the storm. Where to invest? So, if Grantham smells trouble, where should investors look for safety? His advice is surprisingly straightforward. Avoid U.S. stocks for now. Why? They're significantly more expensive than stocks in other parts of the world. Instead, he's looking to markets like Japan and emerging markets where valuations are much more attractive. If you absolutely must invest in the U.S. market, Grantham suggests focusing on a few key areas. High-quality stocks. Consider these as the blue-chip, reliable companies that tend to hold their value better during a downturn. Historically, they've outperformed the broader market, especially during rough patches. Climate change solutions. This is a sector with massive long-term growth potential. Grantham believes that companies providing innovative solutions to the climate crisis will likely see strong demand for years to come. Resources. As the world grapples with supply chain issues and increasing demand for things like battery metals, resource companies could offer another potential haven. Remember, the key to surviving turbulent markets is a long-term perspective. Don't panic sell based on short-term news or price fluctuations. Historically, the market has always recovered from downturns, and a well-diversified portfolio is your best defense against volatility. Market ups and downs are incredibly challenging for businesses. That's why having tools that expand your reach is so important. Workity.com is your solution. This free platform connects you to potential customers, employees, and business partners globally. List your business, browse the marketplace, and post classified ads. It's the perfect way to keep your business thriving, no matter what the economy throws your way. Let me know what you think about Grantham's warnings. Do you agree with his assessment? If you found this video insightful, please like, subscribe, share, and hit that notification bell for more market insights. And remember to check the following video.